Welcome to the deep dive. Today we're tackling, well, a true behemoth, Berkshire Hathaway.
hmm
It's not just one company, is it? It's this sprawling collection.
It really is.
And our mission really is to cut through some of that complexity, try and understand what makes it tick, you
And
know?
what drives the value, what's actually going on inside.
Exactly, and why it matters to all of us.
Right. And we've pulled together quite a bit for this: financial reports, company statements, news analysis, trying to get that clear picture.
Good stuff. And for you, the learner listening in, this is a chance to get smart, fast, on a business that's, well, it's shaped industries, hasn't it?
Absolutely. A giant.
We're aiming for those aha moments, those, surprising insights without getting totally bogged down in jargon.
Yeah, keep it understandable.
Okay, let's get into it.
All right, so at its heart, Berkshire Hathaway is what you'd call a diversified holding company.
Holding company. Okay.
Think of it like a parent company. Yeah. It owns controlling stakes in a whole bunch of different businesses across lots of different sectors.
So not just one focus, many things under one big roof. What kind of things are we talking about?
Well, the biggest piece of the pie,
Mm-hmm.
both in terms of revenue, so the money coming in, and profit. That's insurance.
Insurance, right, like Geico.
Exactly. Geico's probably the best known one. But also their reinsurance businesses, insurance for insurance companies.
Gotcha.
And recently that whole sector's been roughly a quarter of their total revenue and almost half their pre-tax earnings in some quarters.
Wow, half. That's a huge chunk. What's next then?
Manufacturing's another really big one.
Yeah.
That brings in around 21% of revenue, maybe 25% of the profit.
Okay, still significant.
Then you've got BNSF Railway.
The railroad.
Yeah, absolutely crucial for moving goods across the U.S. That's maybe 6% of revenue, but it punches above its weight on profit, about 13%.
Huh. So less revenue share than manufacturing, but proportionally more profitable.
Interesting. Yeah, it is interesting how the margins differ.
What about energy? I know they're in that space too.
They are. That's under Berkshire Hathaway Energy, BHE. Mostly utilities. That accounts for maybe 8% of revenue.
Yeah.
Then you lump together their service and retail businesses. That's another 11% or so.
You're right.
And more recently, since they bought the rest of it, Pilot Travel Centers.
The truck stops.
Yeah, the big truck stop network. That kicked in about 14% of revenue in 2023, now that they own it all.
Man, it really is diverse. Essential stuff too. Insurance, manufacturing, rail, energy, retail.
Pretty much touches everything. And then, of course, there's the whole investment side.
Right, the massive stock portfolio.
Absolutely. Berkshire holds huge stakes in other public companies. The Apple position is like the famous example, isn't it?
It really is.
And it's important to remember those gains or losses on the stocks they own, even the ones they haven't sold, the unrealized ones. They have a big impact on the bottom line, the reported net income.
Ah, okay. So the official profit numbers can jump around a lot depending on how the stock market's doing, even if the underlying businesses are steady.
Exactly. You see these huge swings sometimes.
Now, all these different businesses, who are they actually serving? Who are the customers here? The scale must be massive.
Oh, it's immense. Tens of millions of customers, easily. Both individuals and businesses.
Tens of millions.
Yeah, just think about Geico, right? Something like 16 million active insurance policies.
Wow.
Or BNSF, moving freight for thousands of different companies. They handle, maybe 40% of the long-distance freight volume in the U.S.?
40%. That's incredible.
It's huge. And Berkshire Hathaway Energy. Millions of homes and businesses rely on them for electricity and gas. Around 5.3 million retail customers.
So a truly enormous, varied customer base.
Exactly. And that's a core strength. They aren't overly dependent on any single product or service or customer group. That diversification brings a lot of stability.
Okay, that gives us a good feel for what Berkshire is. But every company faces challenges. What are they up against? Short-term, long-term?
With short-term, definitely the broader economy. Macro stuff.
Like inflation, interest rates.
Exactly. High inflation, rising rates that can push up the cost of insurance claims. Think car repairs for Geico.
Right.
And it makes borrowing money more expensive for big capital projects at the utilities or the railroad.
So costs get squeezed from different directions.
Precisely. And if the economy slows down significantly, that could mean less stuff for BNSF to haul.
Less freight traffic.
Yeah. And potentially weaker sales for their retail businesses, too. Then there are always things like Geopolitical events, supply chain hiccups, those can hit the manufacturing side.
Always a risk these days.
And like we mentioned, market volatility, those swings in their stock portfolio can cause these big paper gains or losses in their reported GAAP profits.
Yeah, profits, right. The official accounting number.
Yeah. They reported a massive loss in 2022, like $23 billion, then a nearly $100 billion profit in 2023. Buffett calls those swings wild and capricious. Mostly on paper, remember.
Okay, so short-term headwinds tied to the economy and markets. What about the bigger picture? Longer-term risks or challenges?
Well, the elephant in the room, or maybe the two elephants historically, has been management succession.
Right. Buffett's age, Munger's passing.
Exactly. Warren Buffett is 94. Charlie Munger passed away at 99 late last year. So the question is crucial. Who leads Berkshire next and how?
And they have designated successors, right?
Yes. Greg Abel, who oversees the non-insurance businesses, is the designated CEO successor. And Ajit Jain runs the massive insurance operations. They're both appointed vice chairman back in 2018, and Abel's role has clearly grown.
Still, huge shoes to fill. What else looms long-term?
Just sheer size, and because of constraint on growth.
The law of large numbers.
Kind of, yeah. When you're managing, close to $1 trillion in assets now, finding acquisitions big enough to actually move the needle, to make a meaningful difference, it's really, really hard.
Elephant hunting, as Buffett calls it.
Exactly. And he's acknowledged himself that the kind of growth rates they saw in the past, they're just much harder to achieve now.
Makes sense. Anything else?
Climate change is a big one, especially for insurance.
More storms, floods, fires?
Potentially, yeah. Increased catastrophe losses for Geico, Gen Re, the whole insurance group. That's a long-term risk they have to manage.
And for the railroad? BNSF?
There's secular risks there, too. The decline of coal, for instance, that used to be like 20% of their volume historically.
Wow, that's a big shift.
It is. Plus, ongoing competition from trucking. And maybe, down the road, autonomous trucking. That could change the game.
True.
And then there's always regulatory and political risk. Changes in laws affecting insurance, railroads, energy, taxes.
There's like the 2017 tax cut. That was a boost, right?
It was a significant boost, yes. So change it can go both ways. And finally, market risk. With a $350 billion plus equity portfolio, their results are inevitably tied to the fortunes of the wider market and major holdings like Apple and Bank of America.
Oh, okay. A lot of different forces to navigate. Let's switch gears and talk about costs. Running this kind of empire, the cost structure must be incredibly varied.
Oh, absolutely. It's a conglomerate, right? So the cost mix looks totally different depending on which part of the business you're looking at.
So take insurance first?
Insurance, a huge chunk of the cost is variable. It moves with the business, the biggest variable cost, paying out claims.
Makes sense. More claims, higher costs.
Exactly. For Geico specifically, advertising spend is also a major variable cost, though they actually cut that back quite a bit in 2023, interestingly. About 16.5% cut, lowest spend in 14 years.
Trying to boost profitability.
Seems like it, yeah. And the costs of actually underwriting the policies, processing applications, managing policies, that also fluctuates with the volume of business they write.
Okay. What about the businesses with big physical assets, like the railroad?
BNSF, yeah. Very high fixed costs there. You've got 32,500 miles of track, all the locomotives, the infrastructure.
Yeah.
Maintaining that costs a lot, regardless of how much freight they move.
Big fixed base.
Huge. The main variable costs for the railroad are things like fuel, which is also about 80% of their greenhouse emissions, by the way, and paying the crews.
And did costs change much recently?
Well, in 2023, freight volumes were down a bit, and that actually helped reduce their overall operating expenses by about 2.5%. Less fuel used, maybe some adjustments in staffing.
And utilities. Similar high fixed costs.
Pretty similar, yeah. Berkshire Hathaway Energy has heavy depreciation costs from their power plants and grid infrastructure, plus interest costs on debt. The variable side is mainly fuel for power generation and any electricity they have to buy from others.
Okay. And manufacturing and retail. More traditional, maybe.
Generally, yeah. Variable costs are things like raw materials, lumber for Clayton Homes, steel and resins for Marmon or Shaw Industries, plus direct labor, distribution costs. Then you have the fixed overhead for factories, stores, etc.
And across the whole group, labor must be massive. How many employees do they even have?
It's around 383,000 back in 2022. So yeah, compensation is a significant cost across the board, and many are unionized, especially at BNSF. They actually had a charge of nearly $300 million in early 2024 related to a new labor contract.
So biggest cost buckets overall? Insurance claim payouts.
Definitely. Cost of goods sold for the manufacturers.
Raw materials. Labor.
Right. And compensation across the entire enterprise. For BNSF, fuel and comp are the bulk of their like $17 billion in operating costs. BHE, it's fuel and maintenance.
How have these costs been trending? We talked about Geico cutting ads.
Right. That shows the flexibility on the variable side. Geico also cut headcount by about 20% in 2023, reduced underwriting expenses overall. When things slow down, variable costs tend to adjust less fuel burned by trains, maybe fewer insurance claims if people drive less.
But fixed costs are stickier.
Much harder to adjust quickly, yeah. But Berkshire's diversified model usually keeps overall earnings positive even in recessions. On the flip side, when things boom, or during inflationary periods like 2021-22, costs can rise. We saw that with higher auto claim severity, more expensive repairs, and input cost inflation for the manufacturers.
But their size helps manage costs, too.
Yeah, economies of scale definitely help. And having strong competitive positions in many of their markets gives them some pricing power and efficiency advantages. Geico's underwriting, for instance, improved dramatically in 2023. The loss ratio went from nearly 105% down to about 81%. Fewer accidents, better pricing, cost cuts, all helped.
Okay, let's talk leadership. Buffett and Munger, an incredible track record.
Absolutely legendary. I mean, Buffett's been chairman and CEO since 1965. Munger was vice chairman for decades until he passed. They are the architects of modern Berkshire.
Their philosophy permeates everything.
Completely. And the succession plan seems quite clear now. Greg Abel as the designated CEO successor, Ajit Jain running insurance, both vice chairs since 2018. Abel's been taking on more public-facing duties, too.
What about the board?
14 members as of 2024. Includes some Buffett family members, longtime insiders. They did institute a new policy recently. Directors, other than Buffett, have to retire at 95. Ron Olson stepped down because of that.
And the results speak for themselves, right?
I mean, yeah. The long-term results are just extraordinary. Book value per share compounded at nearly 20% annually from 1965 to 2022. The S&P 500 did, what, maybe 10% over that same period?
Incredible outperformance.
And built on a reputation for integrity. Buffett's annual letters are famous for their candor. His line, "We can afford to lose money, but we can't afford to lose reputation." That really sums it up.
That transparency is unusual. No quarterly calls, no guidance.
Right. But then you have the annual meeting. That marathon Q&A session is, in its own way, incredibly transparent. Shareholders get hours to ask Buffett, Abel, Jain, anything.
The unique approach.
Very unique. And the stability. The management tenure is unparalleled, not just at the top, but the CEOs of the subsidiary companies often stay for decades, running their businesses with a lot of autonomy.
And their knack for capital allocation, making big bets at the right time.
Definitely a key skill.
Yeah.
Those deals during the 2008 crisis, Goldman Sachs, GE, Bank of America, in 2011. Opportunistic moves when others were fearful.
Although some felt they could have done more in 2020.
There was some critique, yeah. Maybe they were a bit less aggressive than in '08. But overall, the discipline is clear. Holding huge amounts of cash, like $147 billion at the end of 2022, when they don't see compelling value. But willing to act boldly when they do.
And their personal interests are aligned with shareholders, right?
Yeah.
Through stock ownership.
Hugely aligned. Buffett and Munger always had the vast majority of their immense wealth tied up in Berkshire stock.
Yeah.
Buffett owns shares worth, well over $130 billion. Never sold for personal spending.
Never sold. Remarkable.
It really is. And the compensation structure reinforces that alignment. No stock options or big equity grants for the top execs. Buffett's salary is famously $100,000, unchanged for decades. Abel and Jain get a flat $20 million salary.
So the incentive is purely through owning the stock themselves.
Exactly. They're encouraged to buy stock with their own money. It avoids diluting existing shareholders through options. Plus, there's that frugal ethos coming from the top.
And share buybacks fit into this alignment picture, too.
Yes. When the stock is viewed as undervalued, buying back shares effectively increases the ownership stake of the remaining shareholders, including themselves. Greg Abel bought $68 million worth of stock himself back in 2022. That sent a strong signal.
So management eats its own cooking, so to speak.
Very much so. Now, Buffett can be blunt with shareholders sometimes. He resists pressure for things he doesn't believe in, like paying a dividend or maybe buying back shares aggressively when the price isn't right. But he's usually very forthright about performance, even admitting mistakes, like perhaps overpaying for precision cast parts.
The governance is a bit unconventional, though, isn't it? Buffett as chairman and CEO, the voting structure.
It is unconventional by today's standards. But it's hard to argue with the results shareholders have enjoyed over the decades.
Fair point. Okay, who are the big shareholders besides Buffett, and what kind of influence do they have?
Well, there's that dual-class share structure. Class A shares have most of the voting rights. Class B have much less voting power per dollar invested.
So Buffett's control comes from holding those A shares.
Primarily, yes. He holds about 15% of the economic value, but controls around 30% of the votes. Add in family and the Munger estate, and insiders control maybe a third of the voting power.
So they have effective control. Who are the big outside holders?
The usual suspects, really. The big index fund managers. Vanguard's the largest, holding around 6.7%. BlackRock maybe 4.9%. State Street about 3.1%. These are as of early 2024. Vanguard holds something like 145 million B shares.
And do these big institutions push back much?
Generally, they vote with management on routine stuff, but they have supported some shareholder proposals, especially on ESG topics, environmental social governance, even when Buffett opposed them.
Like what kind of proposals?
Back in 2021, there were proposals asking for more detailed reporting on climate-related risks and diversity initiatives. They got roughly 25% support, which is significant given Buffett's opposition. Some big players like BlackRock actually voted against management on the climate disclosure one.
What was Buffett's argument against it?
He argued it wasn't practical given Berkshire's decentralized model, with all the subsidiaries operating independently.
What other topics come up in proposals?
Recurring ones include separating the CEO and chairman roles, which Buffett holds. That gets proposed fairly often, but rejected due to his voting power, though the board did implement that director retirement age policy instead last time. Sometimes questions about executive pay or succession transparency.
And the dividend proposal.
That comes up too. Berkshire hasn't paid one since 1967. Buffett is staunchly against it, arguing he can reinvest the cash within Berkshire and generate better returns for shareholders over time.
So essentially, Buffett's voting power means shareholder proposals he opposes don't pass.
Pretty much, yeah. He votes against calls for extra reporting or governance changes he deems unnecessary, and that usually carries the day. Climate, diversity, governance structure, these have been the top voted topics recently, but ultimately rejected.
Though the board has made some voluntary changes.
Right. They have adopted some things voluntarily. Buffett's philosophy seems to be, if it ain't broke, don't fix it, especially if the fixing involves just adding layers of reporting. And most shareholders seem content to trust his stewardship, given the stock's performance.
Let's dive deeper into those share buybacks. You mentioned the shift in strategy.
Yeah, it's been a noticeable evolution. For decades, basically no buybacks, no dividends, all cash reinvested.
Right.
They started a small program in 2011, initially tied to buying only below 1.1 times book value, later relaxed slightly to 1.2 times. Not much happened.
Pretty restrictive.
Very. The big change was mid-2018. The board gave Buffett and Munger discretion to repurchase shares whenever they believed the stock was trading below its intrinsic value, ditching the strict book value link.
And that opened the taps.
It did, especially in the last few years. They bought back very little between 2011 and 2018. Then 2019 saw about $5 billion.
Okay, starting to get significant.
Then 2020, during the COVID market dip, a record $24.7 billion. Buffett noted that increased continuing shareholders' ownership by over 5%.
Wow.
2021 was even bigger, $27.1 billion. That was the highest ever. Over those 2 years, they retired something like 8% of the company's shares.
That's a major reduction, but then it slowed down.
It did. As the stock price climbed in 2022, they only bought back about $7.9 billion. In 2023, it slowed to a trickle, just $1.3 billion in the first half, and basically none in the second half as the stock hit new highs. The share count barely changed in late 2023.
So truly opportunistic, buy when cheap, stop when not.
Exactly. Buffett is disciplined. He buys aggressively when he sees value, stops when he doesn't. The halt in late 2022 and 2023 proved that.
What about more recently, 2024, 2025?
They picked up a bit again. About $2.3 billion in Q1 2024, around $2.9 billion for the full year 2024, and continued buying in early 2025.
Do they have a limit on how much they can buy back?
The current board authorization is huge, up to $106 billion, with no expiration date. So there's plenty of room to act if they see fit.
It's a big shift then, from the share count only ever going up due to acquisition.
To actually shrinking significantly, around 10% reduction between 2019 and 2022.
And the logic is it increases the remaining shareholders' slice of the pie?
Precisely. It's accretive to per share value if done below intrinsic value. Buffett always emphasizes that he condemns companies that buy back stock indiscriminately just to prop up the price.
And those 2020-21 buybacks done at prices around $280 for the B shares, they look pretty good now with the price over $500.
Very good in hindsight, yes.
So going forward, probably more intermittent buybacks.
Seems likely. The plan is clearly to buy when Buffett and eventually Abel see good value. At the 2024 meeting, Buffett basically said the stock wasn't screamingly cheap, hence the modest buybacks. Maybe not far above their buy threshold, but not compellingly below it either.
Shareholders seem okay with this flexible approach.
Generally supportive, yes, though some always want more. But Buffett won't buy at any price. It really highlights that contrast with, say, 10 years ago. Back then, the focus was almost entirely on finding those elephant-sized acquisitions. Now, with huge deals harder to find and the cash piling up, buybacks are a more prominent tool for returning capital when the stock offers good value.
Interesting evolution. Now, what about other big-name value investors? Are they holding Berkshire? Trading it?
Well, Buffett and Munger are the ultimate holders, obviously.
Yeah.
Buffett's stake is enormous, never sold for personal use, only charity. Munger held a significant position too, gave much away, no short-term trading there. Buffett's initial cost basis is incredibly low, like $32 per A share back in the 60s.
Amazing. And his recent buying has been through the company buybacks opportunistically.
Right, like buying back B shares around $300 in late 2022, or maybe 220s back in 2019.
What about someone like Howard Marks' Oaktree?
Not really a significant Berkshire shareholder based on public filings. Oaktree's focus is more on credit, distressed debt, doesn't seem to be a major part of their equity strategy.
Okay, but Li Lu, you mentioned him earlier, Munger protege.
Ah, yes, Li Lu at Himalaya Capital. He's a big holder, often called China's Warren Buffett. He started buying BRKB back in 2021, maybe around the low $300.
Significant position.
Very significant. As of late 2024, owned around 900,000 B shares. It's a top 3 position for him, something like 15% of his $2.7 billion U.S. portfolio. And he seems to only be accumulating, not trading. His average cost is probably somewhere in the mid-$200 for the B shares.
So he sees long-term value.
Clearly. He's expected to just keep holding, maybe adding more. His stake is still tiny relative to Berkshire overall, like 0.04%, but it's huge for his fund. Berkshire, Bank of America, and Alphabet make up over 80% of his U.S. holdings. Very concentrated.
Any other value, folks?
Bill Gates' foundation is a huge holder, of course, via Buffett's ongoing gifts. They have nearly 35 million B shares. People like Seth Klarman at Baupost, Mohnish Pabroy, they've owned Berkshire at different times. And the internal managers, Todd Combs and Ted Weschler, have bought personal stakes too.
So the pattern is Buffett holds permanently, Munger did too. Li Lu is a major buyer and holder. Other value guys tend to hold long-term, maybe add on dips.
That seems to be the general picture, yes. The top holders now are Buffett himself, 15% economic stake, then Vanguard, 9% primarily via index funds, BlackRock, 5%, and then a long tail of others holding smaller percentages.
Okay, let's try to pin down that intrinsic value idea. How might Buffett approach estimating it, even if he doesn't give a number?
Right. His definition is clear. The discounted value of future owner earnings, basically free cash flows. He doesn't publish a calculation for Berkshire.
But we can try to approximate it.
We can try. Let's say you estimate Berkshire's sustainable owner earnings are around $40 billion per year going forward. That might be a bit conservative compared to the nearly $47 billion in operating earnings they did in 2024, but let's use it.
Okay, $40 billion baseline, then what?
You need a discount rate. Buffett often talks about a 10% hurdle rate for investments, so let's use 10%.
And growth, it's huge, so maybe slower growth.
Exactly. You can't assume rapid growth forever for a company this size. Maybe assume, say, 5% growth for the next 5 years, then settle into a long-term terminal growth rate of maybe 2%, something below overall GDP growth.
So plug those into a DCF model. What kind of value pops out?
Doing that simple calculation might give you an intrinsic value for the whole company around $650, $700 billion. That translates to roughly $300 and $330 per Class B share.
And the stock is currently around $530.
Right. So that simple DCF suggests it's trading well above that particular estimate. If you wanted a 30% margin of safety on that $300, $330 value, you'd be looking to buy below maybe $210, $230, a 50% margin, below $160.
So based on that calculation, it looks overvalued now.
Based on those specific assumptions, yes. Or, put another way, the current price of $530 seems to imply the market is using a lower discount rate, maybe closer to 6-8%, or expecting higher growth. At $530, the expected return, assuming that low single-digit long-term growth, might be more like 8-9%. Solid, but maybe not spectacular.
And Buffett's actions buying heavily in the $200, $300, then slowing way down seem consistent with that view.
They do seem consistent, yeah. It suggests his own internal buy zone is probably well below the current price.
Could his intrinsic value estimate be higher than our simple DCF suggests? Maybe because of the insurance float or other factors?
It's possible. The value of that massive insurance float, currently around $170 billion, which Berkshire gets to invest for its own benefit, is hard to capture perfectly in a simple FCF model. And the look-through earnings from their equity holdings might also add value beyond reported operating earnings. These factors could justify a lower discount rate or a higher estimate.
So what's a reasonable range for intrinsic value? Trying to think like Buffett.
Maybe a range of $300 to $400 per B share is plausible, considering those nuances. The current price above $500 still suggests the market is pricing in high single-digit returns, with not much margin of safety left.
So if you demand a 15% return, it looks overvalued. If you're happy with 8%, maybe it's reasonably valued.
That's a good way to put it. Buffett seems comfortable holding, but not aggressively buying back shares, which suggests the price is near, but maybe somewhat above, his buy zone. He did hint at the 2024 meeting he'd resume large buybacks if the stock fell significantly.
That preference shift again from acquisitions to buybacks when the price is right.
Exactly. It's become a key part of the capital allocation strategy.
Okay, let's look at the actual recent results. Q4 2024, Q1 2025. How do they do?
Very strong finish to 2024. Operating earnings in Q4 were up a massive 71% year over year.
71%. What drove that?
Two main things.
Yeah.
A huge turnaround at Geico, much better underwriting results, and significantly higher investment income from the insurance portfolio. Rising interest rates really boosted the interest and dividends they earned on their bonds and stocks.
So insurance was the star. How about the rest?
Utilities energy did better. The other category improved. BNSF profits were roughly flat for the quarter, but up slightly for the full year.
And the full year 2024, how did that shape up?
Revenue was up slightly, about 1.9% to $371 billion. Higher insurance premiums and manufacturing services sales offset lower railroad volumes. Importantly, expenses were actually down 1.7% thanks to cost-cutting at Geico and BNSF.
Lower expenses driving higher profits.
Yeah, exactly. Operating profit margins widened. Insurance underwriting turned a $9 billion after-tax profit, up 66%. Insurance investment income jumped by over $4 billion. BNSF's profit was up about 14% to $5.8 billion, despite flat revenue shows good cost control, efficiency gains. BHE profit was sharply up to $3.7 billion.
What about the overall net earnings, including the investment swings?
Net earnings for 2024 were $89 billion. That was actually slightly below 2023's $96 billion, but that's purely due to those gap investment portfolio swings. 2023 had huge gains, 2024 some losses offsetting gains.
Right, focus on operating earnings.
Exactly, and operating earnings were $47.4 billion in 2024, up a very strong 27% from $37.3 billion in 2023. Operating EPS for the B shares was $41.27.
Yeah, and the cash pile.
Grew again, ended 2024 around $134 billion. Buffett calls it their fortress liquidity. Book value per share also grew nicely, up about 13%.
And the positive trend continued into 2025.
Yes, the Q1 2025 results released in May showed continued momentum. Geico remained solidly profitable with another good underwriting gain. Overall operating earnings were up year over year, though GAAP net income was lower because Q1 2024 had particularly large investment gains to compare against. At the 2025 meeting, Buffett said most businesses were doing well despite a softer economy, and mentioned they'd invested about $4.4 billion more into Japanese trading companies and other equities early in 2025.
So the takeaway from recent earnings is resilience and profit growth.
Definitely. Insurance dramatically turned around. Geico's combined ratio went from almost 105 in 2022 to just over 90 in 2023, and improved further in early 2024. Railroad managed costs effectively. Overall operating earnings growth over 25% in 2024 is impressive. Strong results plus buybacks pushed the stock to all-time highs in 2025. Buffett called 2024 a good year with over $30 billion in retained earnings added to their capital base. Looks well positioned.
Okay, impressive recent performance. Now let's zoom way out. 30 years, 1995 to 2024. What does that long view tell us?
It tells a story of absolutely staggering growth. Revenue went from around $4.4 billion in 1995 to $371 billion in 2024. That's like a 16% compound annual growth rate.
16% a year for 30 years. Incredible. Driven by acquisitions partly.
Big time. You see huge jumps when they bought Genre in 98, BNSF in 2010, but also organic growth, reliable long-term top-line expansion.
What about profits and margins over that time?
Net income grew even faster generally. from about $600 million in 95 to that peak of $97 billion in 2023. Margins improved, too, from maybe 10–15% back then to consistently over 20% more recently if you smooth out the accounting noise. Net margin hit 27% in 2023, 24% in 2024. Operating margins trended up.
Any lost years in there?
Only one net loss year on a GAAP basis, that was 2022, the $22 billion loss driven by market drops. Operationally, they remain profitable. Underlying return on equity has probably averaged around 10–15% most years.
And the balance sheet, assets, equity.
Just ballooned. Assets grew from $30 billion to $1.15 trillion, a 38-fold increase. Shareholders' equity, or book value, went from $17 billion to $651 billion, so it's about a 14% CAGR. And book value per share grew even faster because of the buybacks later on. Equity basically doubled each decade.
Wow. 30 times growth in net worth over 30 years. What about leverage? Did they borrow a lot to fuel this?
Surprisingly little relative to their size, and especially compared to other financial companies. Their debt-to-equity ratio has averaged about 1.13 over the 30 years. But that includes the huge insurance float, the $170 billion they hold, but don't technically own as a liability. If you look at actual interest-bearing debt, it's much lower. The debt-to-equity ratio actually improves significantly, ending 2024 at 0.77, one of the strongest levels in decades.
So they funded growth mostly internally.
Largely through retained earnings, yeah. Total liabilities relative to assets have also come down from around 53% on average to about 43.5% in 2024. They have a massive equity cushion, which is a huge competitive advantage. Plus, exceptional liquidity with that giant cash hoard.
So the 30-year summary, massive scale increase, improving profitability, and actually increasing financial strength.
That's it, exactly. Double-digit growth across the board. Consistent profitability even if GAAP net income is volatile. Steady compounding of book value. Minimal net debt. Just remarkable consistency and scale.
Let's drill down on some key metrics over that 30-year span, earnings quality and growth.
Earnings growth has been very consistent underneath the noise. Geometric mean probably around 20% annually from 95 to 24 for net income, though operating earnings growth might be a bit steadier. Return on equity averaged maybe 10–12% long-term, which is solid given their low leverage and enormous size.
How has ROE trended?
Underlying operating ROE has been reasonably steady in the low double digits. The GAAP ROE jumps around a lot with investment gains. As their equity base grew exponentially, maintaining that ROE percentage meant generating vastly larger dollar profits each year. Diversification helps ensure consistency.
What about market valuation, PE ratio, price to book?
The PE multiple has generally been pretty modest. It was higher back in the late 90s tech bubble, but compressed quite a bit over the last decade or two, often in the 12–15 range in the 2010s, sometimes even lower, like 8–12 in 2020–23.
Why so low compared to the market?
Partly reflects the large chunk of earnings coming from the stock portfolio, which the market might see as lower quality or less predictable. Also implies expectations of slower future growth due to size, and maybe reflects understated look-through earnings from their equity holdings. Berkshire often trades at a discount to the S&P 500's PE.
And price to book, that used to be the key metric for Berkshire, right?
It was, historically. It fluctuated mostly between 1.0x and 2.0x over the 30 years, maybe 1.5 by 1.8x in the 90s, then mostly 0.8 by 1.3x in the 2010s. It even dipped below 1.0x briefly in the early 2000s and the 2008 crisis. Buffett himself signaled 1.2x book as a floor for buybacks back in 2011.
But less useful now.
Buffett thinks so. Because the huge Apple stake is marked to market value on the balance sheet, it causes big swings in book value that might not reflect the underlying operating business's performance. At the end of 2024, PB was around 1.5x. The market cap of nearly $1 trillion was significantly higher than the $651 billion book value. The trend since 2010 has been a lower average PB, maybe around 1.3x, suggesting a more value-oriented perception by the market.
Free cash flow must be enormous.
Absolutely enormous.
Yeah.
They generated about $33 billion in free cash flow in 2024. That's after about $17 billion in capital expenditures. Operating cash flow was closer to $50 billion.
And it all gets reinvested, no dividends.
Correct. All reinvested or added to the cash pile. Operating cash flow has grown consistently with earnings. CapEx has grown too, mainly due to the needs of BNSF and BHE. They reinvest a substantial portion of their operating cash flow back into the businesses, maybe 40% in 2024. But they still generate way more cash than they use internally, hence the swelling reserves. FCF has averaged over $20 billion annually recently. Robust.
And balance sheet strength, liquidity confirmed over 30 years.
Absolutely rock solid.
Yeah.
Current ratio always well above 1 due to the cash, huge interest coverage. Most debt is at the subsidiary level, like BNSF and BHE, and it's investment grade, easily serviced by their cash flows. The parent company is swimming in net cash. The debt-to-asset ratio trended down from maybe 55% in 2000 to 43% in 2024, more equity-heavy over time. Interest-bearing debt is an even smaller slice, maybe 10% of assets.
So the overall 30-year financial picture is bigger, stronger, more diverse, consistently profitable, and financially more conservative over time.
That sums it up well. Growth has inevitably slowed from the early days, but still outpaces the general economy. Profitability remains solid. Per-share value compounding is healthy, boosted by buybacks. The market often prices it conservatively, maybe making it look undervalued at times. The recent run-up has closed some of that gap.
And that financial strength let them play offense during crises.
Crucial point. That ability to weather storms like 2008, 09, or 2020 and deploy capital countercyclically when others couldn't is a hallmark of their success. Consistency and financial firepower.
Seeing these trends visually in graphs must be powerful. Share price.
The share price graph, BRKB, is just a classic exponential growth curve, isn't it? Pullbacks during crises, but always recovering and hitting new highs. Roughly 13% compound annual growth, beating the market long term. Relatively flat from 98 to 05, then surged in the 2010s. Quick recovery from the 08 and 20 dips.
And the valuation multiples, PE, PB.
Those graphs show a clear trend. PE was elevated in the late 90s, maybe 25, 30x, but significantly compressed since then, often 10, 15x in the 2010s. PB fell from around 1.6, 1.8x in the 90s to mostly 0.8, 1.3x in the 2010s, dipping below 1.0x in 2011 and 2020. The overall trend is definitely declining valuation multiples. It became more of a classic value stock profile over time.
What about per-share earnings and cash flow?
Those graphs show tremendous growth. EPS went from maybe $1 for the B-share equivalent back then to over $40 now. Yes, volatile year to year because of investments, but the smooth trend is strongly upwards. Free cash flow per share similarly climbed, becoming huge by the 2010s. Per-share performance has been consistently positive, amplified by the share count reduction in recent years.
Shareholders' equity graph.
Just a steady, relentless upward climb, almost bending upwards over time. You can see inflection points for the big acquisitions. Growth seemed to accelerate again from 2016 to 2021. By 2024, equity was 38 times the 1995 level. Shows the power of reinvesting earnings at high rates historically.
And the leverage graphs. Debt equity, debt assets.
Those clearly show the deleveraging trend. Debt to equity trended down, often above 1.0 in the 90s, falling below 1.0 by 2020, hitting that low of 0.77 in 2024. Debt to assets fell similarly. The balance sheet just got stronger and stronger as retained earnings grew the equity base faster than liabilities.
And net income margin.
That graph zigzags a bit, but shows an upward bias over the long run. Rose from maybe 10% in the 90s towards 20% plus more recently, excluding the big investment swing years. Spikes and dips due to investment gains losses or big catastrophe events for insurance. But the baseline seems to have increased, suggesting they got better at converting revenue into profit, maybe due to business mix changes, efficiency gains at Jacobi and SF.
So the graphs confirm the story, evolved from smaller, maybe higher leveraged in the 90s, to a gigantic, financially conservative powerhouse today, with steadily increasing earning power, even if investors value it at lower multiples now.
Exactly. And Berkshire countered that lower multiple trend by reducing shares and maintaining strong returns, continuing to deliver that per-share intrinsic value growth.
Okay, let's wrap up with valuation. A conservative, discounted cash flow model, what does that suggest? Base case.
All right, base case DCF. Using that normalized FCF estimate around $35 billion for 2024, assume 5% growth for 5 years, then 2% terminal growth, discount rate of 10%.
Okay.
That kind of calculation might point to a total company value around $650 billion, or maybe $270, $300 per B share.
Still well below the current $530 market price.
It is, which suggests that to justify the current price with a 10% required return, you need higher growth assumptions. Or, more likely, the market is pricing it for a lower return, maybe closer to 8%.
What about a bear case? Pessimistic outlook.
Okay, bear case. Let's say FCF stays flat at 35 Bs, 0 growth for 5 years, then only 1% terminal growth. Maybe use a higher discount rate, say 12%, reflecting more perceived risk or high returns requirement.
That gives.
That could push the DCF value down to maybe $450 billion total, or only $180, $210 per B share, obviously far below the current price. Shows significant overvaluation if you believe that very harsh scenario.
And a bull case. More optimistic.
Bull case. Maybe start with $40 billion in FCF, grow it at 6-7% for 5-7 years, 2.5% terminal growth. Maybe use a slightly lower discount rate, like 9%, reflecting high quality, That could get you towards $900 billion or more, so $400 plus per B share. Closer to the current market cap, but still needs fairly optimistic assumptions.
So DCF is very sensitive to those inputs.
Highly sensitive, especially for a long-duration asset like Berkshire. Small changes in growth or discount rate have big impacts.
What's the main takeaway from the DCF exercise?
I think the base case confirms it's probably not deeply undervalued right now, at least using standard assumptions at a 10% hurdle rate. It aligns with Buffett slowing down buybacks. The bear case provides a sense of a margin of safety target. If you wanted a protection against zero growth, you'd look to buy much lower. The current price seems to imply acceptance of maybe 6–8% long-term returns.
So maybe a hold for moderate growth, but not a screaming buy.
That seems like a reasonable assessment based on conservative DCF, yeah. Low risk of permanent capital loss. Probably moderate reward from here. Unlikely to be explosive upside, but likely a steady compounder. If you demand a 15% return, you'd need a much lower entry point, maybe low $200. If you're content with 8%, maybe today's price is justifiable.
And Buffett's actions seem to signal he's comfortable, but not pounding the table to buy aggressively right now.
Exactly. Near his value estimate, perhaps, but maybe a bit above the buy zone where he deployed billions rapidly. Of course, Berkshire's valuation is supported by that fortress balance sheet, the sheer scale, the look-through earnings, the float. It will churn out cash for decades. Conservative DCF shows substantial value, just maybe not a huge bargain today.
Investors have to weigh the safety and quality against perhaps a slower future growth trajectory.
That's the trade-off, yes. Very high safety, very high quality, but likely moderate growth going forward. Conservative analysis suggests low risk, moderate reward at current prices.
Okay, let's try to summarize the key takeaways from this deep dive. Berkshire Hathaway. It's this massive, incredibly diverse company, isn't it?
Absolutely. Involved in so many essential industries: insurance, manufacturing, rail, energy, retail, investments.
Financially, it's a fortress. Extremely strong balance sheet.
Rock solid. Run with a very long-term perspective by legendary management, now with a clear succession plan in place. And that alignment between management and shareholders is really strong.
It faces challenges, sure, economic cycles, long-term shifts, the sheer challenge of its size.
Definitely. But its history shows incredible resilience and an ability to consistently grow its underlying intrinsic value over decades and decades.
And thinking about valuation, maybe not a table-pounding bargain right now based on conservative estimates.
Probably not. But its fundamental strengths, the quality of the businesses, the consistent cash generation, that makes it a core long-term holding for many investors who value safety and steady compounding.
It really offers insights into Buffett's value philosophy in action too. Capital allocation, discipline, focusing on long-term value over short-term noise.
That's an excellent summary. It truly is a company built for the long haul, guided by those core principles.
And that brings us to our final thought for you, the learner. Thinking about Berkshire's immense scale, the coming leadership transition, what is the next major chapter in its story going to look like? How might big global economic shifts or maybe disruptive technologies impact this giant, this seemingly unshakable conglomerate?
Yeah, it's fascinating to think about how it will continue to adapt and evolve in the decades ahead.
Definitely a lot to consider there. Thanks for taking the deep dive with us.